Hey everyone, it's Tom Karadza. So we're getting this question a lot. What happens next to the Ontario real estate market? Let's just dive into it right now. Let me make myself smaller in the corner here. Start this little PowerPoint that I put together, a keynote that I put together here. So interest rates just went up. The Bank of Canada raised rates yesterday, and they went up half a point. So that's a pretty big deal. I mean, historically, they're still super low, but if you can look over the last 10 years, a half point raise is pretty big. It hasn't happened too often. And when we started this business, Rockstar Real Estate, we were dealing with mortgages of 4.5%, 5.5%. You can see around like 2006, 2007, 2008. Then they came plunging down, and they've stayed low basically forever. People told us here in 2010 they were going to just keep raising them. The central banks did not raise them then. They tried to raise them here and kind of hit a wall. And now they're trying yet again to raise rates back up. And we got that half a point move. And it is freaking everybody out a little bit. So let's talk about it. Here is the inflation rate in the latest number for Canada and the US. So the US number is at a 40-year high at 8.5%. The Canadian number is at a 30-year high, 5.7%. So these are if this is what they're telling us inflation is, then in my family and my beliefs, you know it's a lot higher. But anyway, this is the reported number, 5.7% in Canada, 8.5%. And I mean, this is now already laughable to me because if inflation's kind of ripping at these levels and the Bank of Canada decided to fight this with half a point raise when inflation's at like a 30-year high and going at 5.7, unless they're just going to ease into this over the next little while, it doesn't seem enough to calm inflation, but who knows, between demographics and maybe we're headed into a recession, maybe it is. And that's obviously what we're all trying to figure out. So that's the latest inflation numbers. And I think this chart from Lynn Alden is probably the best chart that summarizes everything we all need to know at a big picture level right now. So if you don't follow Lynn Alden on Twitter, she's absolutely fantastic as a macroeconomic analyst. We actually had her on the podcast a few weeks ago. You can find it on our YouTube channel. She's just kind of brilliant. And she put this chart together that I thought was really well done. I think she said she got this chart idea originally from Ray Dalio. But anyway, it summarizes things really great because if you look back throughout history for information, we can see in the 1940s when debt as a percentage of GDP got to these high levels, let's call it 120% of GDP. What happened was the US government started a financial repression strategy. And what I mean by that is they let inflation rip higher than the yields on their treasuries. So for example, if a treasury yield was yielding, let's call it, 3%, but if inflation was 8%, well then if you take 3% and you subtract 8, you get what's called like a negative real yield. And that's what happened. I guess just at a high level, what that means for myself and my family and perhaps yourself is that if you're earning 3% in that type of environment, but things are growing in price at 8%, you're actually losing 5%. So in that type of environment, you want to own hard assets because the interest that you're making on your money just isn't keeping up with the increasing of price of things or the devaluation of the dollar. So it's a really interesting environment. It catches people off guard. And if you look, they did this for about 10 years. So until they were able to get the debt to GDP down to about 70%, they just let inflation run really hot, much higher than interest rates for almost a decade here. You can see there was a little blip here, but for about 10 years, that was the case. So now if we extrapolate forward to our current environment, you can see that the debt to the GDP in the US, and actually let me pause there for a second. I just want to highlight Canada's 5-year bond right now because it's 2.5%. And this is kind of like a benchmark number for our yields here in Canada. The 5-year bond is often referred to and used quite a lot. So if you're earning 2.5% interest on a Canadian 5-year bond, but inflation is like 5%, the real yield is actually 2.5%. Because if you're earning 2.5%, but everything around you is going up 5% because that's the inflation rate, you're actually losing. You're not gaining. This is really an important concept. So that's kind of what we look at here in Canada. And it's actually what's happening, right? If this is actually the current rate, I just pulled this today. And if inflation we know is being reported at 5.7 or whatever it was, you're losing money if you're invested in this thing. It's just absolutely ridiculous. So if I go back to this chart here, you can see that real yields have been negative for quite some time, but the debt as a percentage of GDP is still super high. So I just added to Lynn's chart here, and I gotta think that for the next 3, 5, 10 years, this is gonna be the strategy until this line gets a lot lower and the debt to GDP comes down quite a lot. They're just gonna let inflation run hot. So even though the central bankers are going to tell us they're raising interest rates, it's my opinion that inflation's likely going to be allowed to run hotter or higher than rates. So that it's going to be in your best interest to own hard assets in that type of environment. I could be completely wrong. You have to do your own due diligence on this. This is just what I'm personally thinking when I look at this. How are they going to let this debt to GDP just keep growing? They're going to try and pull it down. So if we go for, that's Lynn Alden, by the way, that's her Twitter handle, definitely worth a follow. She shares just absolutely fantastic information. So that's how you can find her on Twitter. And I just want to show Canada's government debt as a percentage of GDP. Here we are in relation to other countries. So if the US, which I was just using, is here, there's the US, here's Canada. So we're well over 100% debt to GDP. And sometimes we strangely report this number in this country because some of the pension funds we have invested in Canada are invested in equities. And sometimes the government of Canada will treat that as an asset and deduct that off our debt to GDP numbers. It's really weird. If you want to see how they do that, probably the best website that breaks that down is the Fraser Institute. If you just Google up Fraser Institute Canada, they have a ton of reports showing you what the Canadian government does and how it kind of reports debt to GDP in a really strange manner. But here we are, kind of a general government debt number, and we are over 100% in Canada as a percentage against our GDP. So that's why we have weird things like this, where the Bank of Canada has purchased 87.5% of all the bonds that we issue in this country since 2019. And the Bank of Canada is currently holding about 43% of all of our debt. And what this means just to all of us is that there's not really enough buyers that want our debt at the rates we're offering it. So the Bank of Canada is just like magically printing money and buying that debt. And everyone's going to argue if they're actually printing or what's actually happening. But in my eyes, if no one else wants to buy the debt, Bank of Canada is creating money in thin air and buying the debt to hold interest rates at a certain level. And it's when you look at the numbers, it's actually absolutely ridiculous. And this causes asset prices or inflation in our country. And again, everyone's going to argue if it actually does or how the money gets out into the environment. In my opinion, when you hold rates really low, you make money cheap. You have people go to the bank to get loans and mortgages, creating new money out of thin air, causing inflation in the economy. And if you really want to study what is happening with the Canadian situation, just look at Canada's money supply, or M2. If this M2 chart continues to go up at this rate, here's the pandemic in 2020, and you can see the amount of money printing we've done in this country. Look at the rate or the angle of that chart. If that does not slow down greatly, I would expect inflation to still show itself. We need people to spend the money. We need it to enter the economy. But this, to me, is a bit of a leading indicator as to what the inflation numbers are going to look like 6 or 7 or 8 months down the road. So if you want to check this stuff out for yourself, keep an eye on this number. This is the amount of currency entering our economy in this country. Here's another chart. I can't remember where I pulled this chart. It might have been from one of Lynn Alden's reports. But check this out. In that decade that we were referring to earlier, inflation ripped higher and then it came right down. And then it stayed down for like a year or 2 years. And then it ripped really high again and then it came down. Even kind of went under 0%, deflationary for a little bit. And then it ripped higher again. So over this 10-year window, I think what catches a lot of people off guard is that they keep interest rates in that kind of environment. And when I say they, I mean the central banks. They keep the interest rates really low and inflation kind of rips all over the place. So it's not going to be a steady high number that I would expect over the next 3, 5, 10 years. But if that number comes down too low, they want financial repression. That's how they're going to try and pull their debt number lower. So they're going to do everything in their power to make inflation juice itself higher again. So in my opinion, do not be fooled if the next inflation numbers come down lower. I would imagine that the central banks are going to do everything in their power to make that inflation go higher over the next 3, 5, 10 years. So that's just something to keep in mind. It's not a steady number. So there's rates, this blue line, they stayed low right through that period, but inflation was allowed to run kind of wild. And if you want to see an International Monetary Fund's working paper from 2015, Google this one up. If you just Google IMF, the liquidation of government debt, they literally outline how to get rid of high levels of debt in a country when the economy is not growing fast enough to pay for the debt, which is exactly what's happening in all over the world right now, especially the developed world and especially the G7, so places like Canada. We are not growing our economy fast enough to pay all our debt obligations back. The country doesn't want to default on its debt, so the only other option is to inflate it away. And they use this kind of fancy term, financial repression, to discuss high levels of inflation that are higher than the level of interest rate that's being paid out in the country. So if you want to check out the details of that, that's the paper to check out from 2015. And what happened in the 1940s when that financial repression playbook was in action, you can see at the end of the decade, consumer prices basically doubled almost. It was 90% gain. And that's what I think catches most people off guard. And what I think might happen again is that inflation will go higher, it'll come back down, everybody will be confused on what to do. But at the end of a 10-year cycle, prices are likely going to be double from where they are today as measured in Canadian dollars. And that's just something to be aware of. And I just hate that it happens to Canada, the Canadian middle class, to everybody in Canada who's not aware of it. Everyone pays attention to the short-term headlines that inflation is high or low or interest rates are going up and the real estate market's going to crash. And you kind of miss the big picture. And this, to me, is the big picture of what we likely can expect over the next 10 years. So now what about housing prices in Ontario? So let's check out some data. Here is the average Canadian salary from Stats Canada here in Canada that we pulled. So we put this chart together. And then here is the latest Toronto Regional Real Estate Board average sale prices of properties going all the way back to 1969 or 1970. You can see that's the big collapse in the 90s. That was our biggest real estate correction here in Canada. And then you can see 2017, we had the dip here, and then prices have just ripped. So I think in 2017, everybody thought, or I shouldn't say everybody, but a lot of people thought they were coming down. They kind of reversed course and went up. And now everyone's wondering what happens now. Do we get a 2017 pullback? Do we get something greater like we saw in the 90s? Are we coming down 10%, 15%? Do we just plateau? What's happening? And for that, we have to look into the numbers a little bit deeper. Look at the population growth expected in the Toronto metropolitan area. If you look at these 5-year segments of population growth, so here's 2011 to 2016, and then look at the growth in the last 5 years. It was quite substantial on a percentage basis. And look what is expected. By the way, these charts come from Mike Moffat on Twitter. We will put his Twitter handle in the show notes. In the description of this video, wherever you're watching this. So on YouTube, we'll have this in the description, a link to his Twitter handle, because he puts out some of the best population numbers that we've seen in Canada. And I'm hoping I'm giving the right person credit. I believe that's where we pulled these ones from. But we'll put his Twitter handle and link in the description of this video, so you can check him out there. But check out the population growth that is expected from 2021 to 2026 coming our way. And then it stays relatively high compared to this period back here. So Toronto specifically has a lot of population growth. And if we look at the east side of the city, here's Durham. So here's Durham over the last 10 years, kind of grew really strongly in 2001, 2006. Last 10 years was at this rate. And now it's just expected to be this steady high number coming into the Durham area. Now let's look at Hamilton. So here's Hamilton from 2001 to 2016 or so. Here's the last 5 years. And now look going forward what the expected population growth numbers are for each 5-year segment. I mean, how are we going to deal with this type of population growth when we don't increase our housing supply at the same rate? And check this out. Here's Niagara. Look at Niagara. Like, Niagara is going to explode. If these numbers hold, Niagara doesn't even know what's coming. So around the Golden Horseshoe, around Lake Ontario here in the Toronto area, in this area of Ontario, the population growth is strong. And if we look at this, Ben Rabideau has this great post from, I believe it was back in March. Yeah, there it is, March 31st. And he's mapped single-family home completions against population growth. And this doesn't include condos and that kind of thing, of course. It is just single-family homes, but it is on this downward slope since like 2005. And this is a Canadian number. But across Canada, it's on this downward slope. And population since about 2015 just absolutely exploded. If you look at the right-hand side of this chart, these are absolutely huge numbers. And then we had the population growth come collapsing down with COVID because we kind of didn't have the immigration coming in that we typically have. But now it's rebounding back strongly. So, and Canada just raised its targets for population growth and immigration numbers for this year. I think the target for this year is 411,000 immigrants into Canada. That's a huge number. So that's kind of what we expect going forward against the backdrop of single-family home completions that has been on this downward trend. So it's just interesting because although interest rates are going up and it will cost more to carry property, we have a lot of people coming to this country who sometimes come into the country with access to capital from a greater family base from wherever they're coming from that perhaps are still able to buy properties even if rates creep up a little bit here. So it's this interesting dynamic. And again, we don't have the crystal ball, but we do have this weird structural housing problem. And if you don't think it's structural, check out this report from January 12th from the Scotiabank. They actually said that Ontario would require 650,000 homes for its ratio of dwellings to population to equal that the rest of the country. Let's think about that for a second. Ontario would need 650,000 homes to equal the ratio of homes to families that the rest of the country has. For context here, the population of Oakville, Ontario, so a smaller place on the west side of Toronto, is about 200,000 people right now. Okay? It's 200,000. If you know Oakville, I mean, it's small, but it's not tiny. It's 200,000 people. That would say to me that on average of 2.1 people per family unit in Canada, that's about our average right now. We have roughly in Oakville about 100,000 housing units or so. I am ballparking here. But that would mean at this number, Ontario would need 6 cities the size of Oakville to magically appear out of thin air to just equal the housing to population ratio that the rest of the country of Canada has. That's absolutely ridiculous. And if you look at this next paragraph that I pulled out here, if you compare Ontario to the rest of the G7, we would need 1.2 million homes for the province of Ontario to have the same dwellings to population as our international peers. 1.2 million. We have a structural housing problem here that is completely being ignored. And there's multiple levels of government that need to work together to deal with this: municipal, provincial, and federal. And the federal budget that just came out, when they announced money that's just kind of going out to all these programs, it seems kind of useless to me. We need some coordination between the municipal level zoning, the provincial level mandates that they need for housing, and the federal level. This is a huge problem in this area, and it makes me wonder what exactly will happen to housing prices. Like, can they come down a lot when we are this short in housing? And maybe they can. But it's a backdrop that many areas in North America do not have. And it's why we're kind of paying attention to this kind of stuff. Here it is in chart format. So here's Ontario, total private dwellings to population in 2020. There's Ontario. This line is the Canadian average. This line is the G7 average. So you can see how short we are in this particular province of housing. And we just continue to ramp up the population gains in this country. And a big chunk of that gain through immigration comes to Ontario. It's about 44% of all immigration will come into Ontario. So if I was to kind of summarize this, we have this structural debt problem where the central banks are going to use, they might try to raise rates, but to me, they're purposely going to allow inflation to run hot so that we have this real negative rates, because they're going to try and inflate this debt problem away. And the word for that is financial repression. And that's the play by the central banks. And on top of all that, we have a structural housing shortage. So if this is actually going to play out where we have rates increasing, but inflation is going to rip higher over the next 10 years as like a playbook, as something that they want by design. These central bankers want this by design. If that's really what they're thinking, and of course, I'm guessing like everybody else here, but if that's the play, then to me, you want hard assets. And if we're in an environment in Ontario where we have a structural housing shortage, it would seem to me that even if housing prices change now a little bit when everyone freaks out over the interest rate announcements, that I'm not sure how far down they can come. Maybe they plateau, maybe they come down 5 or 10%. It's absolutely going to be fascinating. Or perhaps we are just going to be in this volatile environment where they went up like 30% over the last 18 months or so. And maybe they're going to come down like 25, 35%. Like maybe we're just in this new environment where it's just volatile up, volatile down. Over the long term, I know that for myself and my family, I just want good hard assets. I just want good hard assets that pay for themselves if it's a rental properties. If you've been around for any length of time with us, you know we also like Bitcoin. I want a good hard digital asset like Bitcoin. And that's the kind of things that we're looking at in this type of situation. And remember, you can't really trust anyone. Don't believe anything I'm saying. Always do your own due diligence and do not believe the central bankers. Because look at this headline from 2020. The Bank of Canada signals no rate hikes until at least 2023. And here we are in 2022 and they've already raised rates twice. So definitely do not believe anything coming from our Bank of Canada or for that matter, any central bankers. Do your own research. And I love this line. This to me is a Bitcoin line. Don't trust, verify. Don't trust anything you're hearing. Always do your own research. Verify it for yourself. So anyway, hopefully that gives you a little insight into what we're thinking about this environment right now. Until next time, your life, your terms.